title company is the one that is going to prepare what's called a closing statement. For residential, it's called the HUD-1. Commercial is called just the closing statement. That closing statement is going to have your closing costs. A lot of times what lenders will do, and watch it, especially if you have a bank, they will slide in. They won't get those numbers over to the title company to the last minute. They'll slide in those numbers and those fees and those, that's what they do. And you know, and then you're stuck at the closing table. The seller is expecting you to close two or 3 days ago, so you got pressure to close. The lender's got the money in, you know, escrow. They're waiting for you to sign. You know, there's all this pressure, and so you end up signing. So understand that your closing costs plus your down payment, that is your total cash invested. So you take your cash flow divided by the total cash invested. Let me just give you an example. Say that you've invested $100,000, and I'll just use even numbers, into a property. That's down payment plus all the closing costs, right? And that property every year generates $10,000 a year. So after all the bills and mortgage, you got $10,000 to put in your pocket. When we take that $10,000 divided by $100,000, and that gets us our cash-on-cash return mark. So that's a 10% cash-on-cash return. And that's really, again, if we're in the Bay Area, that's our target minimum, is 10%. So with that being said, I'll move on. Internal rate of return, it's the whole return of the investment, okay? And it's a little bit more difficult to calculate. I won't go into too much detail on this, but understand that the internal rate of return includes the cash flow, the equity buildup, any tax benefits if you have, or any tax liabilities if you have, the appreciation of the property during the holding period. So this, you have to try to project this, and it's difficult to project appreciation, but it is, you can project what your net operating income is going to be 5 years from now. So an internal rate of return shows you what the overall return of the investment is on an annual basis during a specific hold period. So typically you run it at 5 years. But just know that all that is that's the return of the whole investment, the cash flow, the equity buildup, the tax benefit or liability, and then your appreciation if you have some. So those are some other terms to be aware of. Now I'm gonna kind of wrap this up, and then we'll get into the properties that we have. Okay, there's a bunch of different ways you can go about buying real estate. So I've got 2 specific strategies, and these are more than strategies. These are more avenues, if you will, about going property. Because there's a million different strategies of how you can go buy property. You can buy them, you know, lease option to buy, subject to wraparound mortgages, you know, all cash. I mean, you can buy it. There's a bunch of different stuff like that. So I won't go into that. I'll just go into, there's 2 particular strategies, and I want to kind of tailor this to people if they have self-directed IRAs. But 2 particular strategies, the way you can buy real estate. The first one is the buy individually. So you as yourself, or your IRA. We just learned a little bit about how you as an IRA person or holder, I think that's the right language, can then go and buy property. Well, what's required is typically 30 to 35% down. Now I've heard that some lenders out there are doing 75 to 80% loan to value loans for investment property. I haven't seen that, but I have heard that they're starting to come back. But typically you're going to be looking at about 30, especially if it's 5+ units, 30 to 35% down in today's market. Then what you're going to do is you're going to need to go out and get a loan. Most loans are going to require you to guarantee, to put a personal guarantee on the loan. That means if the bank forecloses, they have the option to sue you. Most times banks don't sue you unless they know you got millions of dollars. And then if they know that, then they might just sue you. But most times they won't sue you. But they'll require you to sign that personal guarantee. Now, if you have a self-directed IRA, one thing I know is you cannot get a loan that requires a personal guarantee. So if you are in that position and you're going out and getting a loan, you have to get a non-recourse loan. So I don't know all the details in regards to that with IRAs, but I know that if you're an IRA holder, you want to get into property, you need to have a non-recourse loan if you're getting that.
Yeah, that's the only way you can actually obtain a loan with an IRA is a non-recourse loan, because it has to have, whether it's institutional or private, it has to have a component to where you personally are not having any influence over the approval of that loan. You're not guaranteeing that loan on behalf of the IRA. It has to be totally separate.
And that's important. Those are hard to get, but they are out there. I did talk to the guy today who finances notes, and he told me that he does it on a non-recourse basis. So they're out there. So,
and I have a list. If anyone wants to send me an email, I have a list that I can give you. There's probably about 8 or 10 institutional lenders nationwide that actually do those types of loans. If you're interested, I can get you over a list.
then this one is most of the time the lender's gonna want you to have some type of experience. They want you to know what you do. And it is critical. Now, okay, if you're starting off and you're going into a deal, you don't know what you're doing, a way that you can show the bank that you know what you're doing is you can bring in a property manager who's been doing this for 30 years and say, hey, this is my property manager. They will be running the property on a day-to-day. That's a way you can convince them. Or another way you can convince them is our second strategy is you can co-invest with partners. You can invest with somebody who is an expert or somebody who does have the experience. And so, before I go into this, what I would say is our company, Infinity Investments, we work as a brokerage and an investment firm. So what that really means is that we work in two capacities. We help clients to buy individually, and then we also put together groups, small groups, to go and buy together as investors. So we work in both capacities. So if you are comfortable enough and savvy enough to do it on your own, obviously, that makes a lot of sense, and we can help you in doing that. Or if you're saying, look, I don't want to deal with all the day-to-day management, or I don't want to, deal with all the morass of running property, or I don't have the experience, you can invest with somebody who does. Lamar went through a couple of different structures, LLCs, TICs, so there's a bunch of different ways you can do it. But the bottom line is you're investing with the team, you're investing with the group, okay? Some of the pros of that is that you spread the risk around. So you're not taking all the risk yourself, okay? There's multiple people put money in. And then you don't have to come up with that whole 30% down. So if we're talking about a property that requires 35% down, if it's you, then you got to come up with that. If it's a group, then maybe you're only coming up with a piece of that, a portion of that. Okay, so you don't have to come up with the whole thing. All right. Also, what you can do with some of the intangibles is you're utilizing the strengths of some of the partners. So somebody who's strong on accounting, they can keep the books. Somebody has a contractor's experience, maybe he can stay on top of the property manager and make sure that the renovation of the units or whatever goes right. Somebody else just has a knack for negotiation. Maybe they can help the realtor in negotiation. So you can utilize the strengths of each partner, okay? Also, in a group, usually one person obtains the financing. Usually, it's only one person who's on the hook, meaning that they have to sign that personal guarantee. So if you're just coming in with cash, that probably is not going to be you. Another thing to remember is if you're only coming in with cash, your liability is only the cash that you invest. You're not liable for the loan or other things that happen with the property, just the money that you invest. Now, you don't want to lose that, but I mean, it's worse. You don't want to lose the money and then be on the hook for the loan and then have somebody sue you. So, investing with a partner can minimize that risk in and of itself. Now, the downside of investing with groups is really the people element, the people who you're working with. So that's critical. You got to make sure the people you're working with, life is too short. You got to make sure the people you're working with, you can work with, you like, right? And that brings some value to the table. That's critical. So make sure that whatever you do, whether you're buying individually or you're buying with partners, you have your own plan together, you know what you want, you analyze the property. Whether you're buying or buying with partners, you still want to look at the income and expense. You still want to evaluate your NOI. And you want to make your decision based on the cash flow. Even if it's a flip property. If we're talking multifamily, even if you flip it, you have to look at the cash flow, okay? So with that being said, I'm going to go into the properties, all right? And before I go into this, I'll give you an example of one we just closed. Now, I didn't put it up here, but this is one we just closed. Now, we flipped this property. We bought the loan on a 5-unit building, okay? We bought the loan. We became the lender. We finished off the foreclosure, all right? Then we got the deed. After we got the deed, we put it on the market, and it took about a month and a half for it to close. The month and a half while we owned the property, the first month we made $1,400 in cash flow. The second month we only owned it for a couple months because the closing went into a week into the closing. A week into the month of November, we got to collect the rents for November. So we got another I think it's between $1,300 and $1,400 for November in cash flow. Now we flipped that property. That was a flip, right? But it was good that that property had cash flow. I've learned, been in business for a little while, and if there's cash flow, if you're doing a flip and you have cash flow, that's outstanding. So I bring that up because I think the key to what we're doing here is doing